With inflation trending lower, global central banks will likely start reducing interest rates in calendar year 2024. There are expectations of 2 to 3 rate cuts by the US Fed this year. The spread between India's 10-year government bond yield and the US 10-year government bond yield is at a multi-year low. Hence, even if the US Fed implements any rate cuts, the RBI will likely maintain a more measured approach to domestic interest rates. While the domestic inflation trend appears benign, the RBI is also likely to monitor the trend in the US Fed rate and policy actions of global central banks. The ongoing phase for the Indian equity market looks very similar to the 2003 to 2007 phase due to healthy earnings growth. Domestic institutional investors have a lot of ammo available to take on any potential FPI selling. The significant outperformance of mid and small caps relative to large caps in the calendar year 2023 has led to their contribution to the total market cap rising to an all-time high. Although the Nifty forward price to earnings is reasonable and at its long-term average, the mid-cap and small-cap indices are trading significantly higher than their respective long-term averages. Gold historically has exhibited a negative correlation vis-à-vis the US dollar. Hence, if interest rates in the US are expected to trend lower, it augurs well for gold. The real estate sector has witnessed a significant uptrend in housing sales within the top 7 cities of India, which is likely to continue going forward. In summary, the prevailing scenario in India indicates a positive outlook across multiple asset classes, that is equity, debt, gold, real estate. Hence, we believe that the calendar year 2024 is a year of the all-rounder, where emphasis needs to be placed on multi-asset allocation in investment portfolios. The temperature gauge index is in the fair value zone. As per the risk profile, investors with the appropriate level of equity allocation should continue to remain invested. If equity allocation is lower than desired levels, we recommend increasing allocation by investing 100% lump sum with bias to multi-cap and large-cap strategies. We recommend increasing the duration in the fixed income portfolio to capitalize on the softening of yields in the next 1 to 3 years. 65% to 70% of the portfolio should be invested in a combination of 1. High-quality roll-down strategies through a combination of 10 to 12 years of maturity bonds or funds, 2. Multi-asset allocation funds that aim to generate efficient risk-adjusted returns through a combination of debt instruments and arbitrage. 3. Equity savings funds that aim to generate enhanced returns than traditional fixed income along with moderate volatility through a combination of equities, arbitrage and fixed income instruments. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to REITs, or InvITs, private credit strategies, and mezzanine fixed income strategies. For liquidity management or temporary parking, investments can be allocated to arbitrage or ultra-short-term, liquid or overnight strategies.